You can, yeah, you can go and start whenever you want. Perfect. Just making a little announcement here in case we have any. Perfect. Okay. So the idea with this that we're going to kind of look at today, we've done a lot of the swing stuff, ranges, supply and demand zones. We're going to be kind of honing in on this kind of mid time frame, like 4 hour and 1 hour. We did a lot of scalping stuff on the previous fireside we did last week. So I definitely give that one a rewatch. We might have to redo that one as well, just because when I recorded that, I didn't get anyone from the Discord's comments. I just had me responding to them. So and I think the feedbacks were super important. But so overall in this structure, we'll kind of go from there. First thing we kind of want to hit on is looking at things like swings and why these things are really matter essentially. So even on the well, I'm on the weekly now. I'll go down to the daily. The reason these things are so reactive overall in this overall structure, why swings are tested. That's the big thing. It's like why do we test stuff like that? Why is June such a massive level? What else is going on here essentially? Well, we've also got the highs and daily opens and closes of a lot of other structure. We've got essentially, creation of supply and demand zones in this level on the daily time frame. And looking at the swings, essentially, it allows us to see ranges at a higher time frame that exists on lower time frames. So when you see something like on the daily, and you say at the highs, right? You've got something like this that we had on the 29th of May. That's the low of the swing. That's the high of the swing, right? Why is it so reactive that when we close below it and then have a test and then close lower, test and close lower? Why do we reject this? So essentially, if we're looking at it from a daily time frame, starting at the daily or the weekly, it's always a good idea to see this because you'll get a lot of reaction at these levels. So again, what do we have here? Is it respective of the 4 hour price action structure? Absolutely. If this is the daily swings, what's going on in here? Are we building a little range on the 4 hour in around about this zone? Yeah. What's your first indication that we're probably going to lose the swing? Well, we actually lost the swing low of it on the daily or on the 4 hour, right? So we lose the low. What do we want to see now? If we've had a nice strong move up, if we've lost the local low, we've lost some structure, what do we expect? Well, everything that comes up, we don't want to make a new high. We don't want to gain things and go higher. And this is why we can start looking at the actual structure of the swing. So from the 4 hour, again, that high is still relevant, 28,071. We'll plot the 4 hour low, go back to the 1 hour. So as we go lower in time frame, we're seeing like how respected this price action structure is. So here again, even on the 1 hour, this is the same thing on the one hour, the 4 hour, and the daily time frame. This kind of swing high essentially that we had on the daily. Is that really important as a major level? Absolutely. Anything that goes underneath and fails it, they're not even able to test it. That's how bad it is. And then if we look at the level below, we have a 4 hour level. So now you have on a lower time frame from higher time frame swings. If this is, you know, uh, relevant on the daily, so get spell today. If that's relevant on the daily 4 hour, 1 hour, is it really important that we don't gain that back? Yes. What happens if we don't? We're still failing it and going lower. What are some other things you can use? Well, we've got the 4 hour level here. We pop up, we test the actual like wick lows from the 1 hour structure we created. That's very bearish. And then we drop down, failure, secondary failure, create new lows, lose structure. We go back up. You can long and scalp these things, right? Oh, fail back down, hold, back to the upside, fail to make a new high. We create another, essential important swing. It pops on the indicator as well, right? This is the swing structure that we have there. Failure, lower, lower, lower. So essentially, when you find these things, these kind of highs that do things that like where the price action from the daily, the weekly, 4 hour, 1 hour, it's all really similar price action. It essentially says that's the level not to gain if you want to go lower. Until we go lower and lose that, essentially everything is a potential short. And even here where we had a bit of a fake out, right? We have a close above. What do we need for a break, a gain of something to go higher? You close above, you have to, bullshit back test and close above it. If you close below it, which we did, what happens next? Your first instinct is to short the level because we're below it. We've tested it. We had a fake out, essentially closing above, then closing back below, and then failing to make that high. And that's over and over and over again. Essentially here, you're also in a flat bottom triangle, right? What does that tell you? If this is support and people are continuing to short into the resistance above, what's happening? What do we know about support and resistance? The more it's tested, the less relevant it is. The less strong it is. And that's because all of the longs get stacked in the same spot. It's one thing, if there's a couple $100 between different levels of longs and shorts in an area, but when they're all in the same spot, where they're all within about 40, $50 of each other, this low, these two lows, that low, that low, that low, that low, all of the longs are building in the same exact area. So once it breaks, it causes the essentially the failure of the high. And most people who don't understand price action, but they want to do my triangle, what do they see? Oh, flat bottom triangle. I should do what's the measured move, right? That's the measured move is the move between the high and the low to break back to the upside, da da da. It's absolutely, idiotic. Like even to the downside. It's like, does it ever play out? No, it's not relevant. The only reason you use triangles to identify price action is that what you're saying is that's all the support. The resistance is still making significant, lower highs. So shorts have a better chance to hold the local level because we're on the 1 hour versus longs that are getting squeezed down to about a $50, $100 little area. And that's how you get these liquidation slides that go off a cliff. So with that and with the higher time frame, we can also use these swings to create what's called supply and demand zones. If we understand what swing structure is right, and why we look at swings, we look at it because we're creating supply and demand in that area. And when you have major supply and demand zones, you want to see step offs where there's a very strong bullish engulfing candle or a very strong bearish engulfing candle. And these create supply and demand zones. Supply being, essentially your shorts to the upside and longs demand zones being to the downside. So if we start out from the daily time frame and we go find some like daily supply and demand zones, what's some things that kind of stick out? Well, when you're looking at these levels, what's really important essentially is holding structure while we have it. And let's see at the highs here, we have like the first, at the high, we have essentially the first bearish zone on the daily time frame. This is a very good example. With supply zones, I'll just create a box. And you can do this for your swings as well. So we'll just call this one supply zone. Why? Because it's bearish. So what do we look at that? What's the high candle? It's that. We can use the body of that candle essentially just to say, well, this is all supply. The easiest way to kind of visualize supply and demand on a higher time frame. Let me put that in the middle, otherwise it's going to bug me. 1 second. There you go. What we're looking at with this, and the reason I have it encompassing the entire essential candle that created the demand zone, which was this bearish candle on the 15th of April, right? Bearish engulfing daily candle. We've created a supply zone in this area. What I'm going to do then, and the rule is for supply and demand zones, is you take it from if that's the creation of the candle, right? That candle there. You then take it from the previous candle to the top of its wick if it's a supply zone, from the low of it to the top of the wick, or if it's a bullish candle, right? And I'll find one at the low. Here's a good one. You identify the candle that's a bullish engulfing, which is this one. You then look at the previous candle. You take it from the top of that candle structure all the way down to the wick, and now this is a demand zone. So you can use this in confluence with swings. I like just normal swing structure because it makes more sense to me. And what you see oftentimes with these levels is that these are the relevant demands until they're lost. The moment you close under demand or above supply, that zone is essentially dead, right? It's still a major level, specifically, that, right? That's the daily SR. It's still gonna be reactive, but that zone as a level of a bounce is gone. It's completely gone once it closed underneath. It said, nope, irrelevant. Let's see if we can create a new demand zone. We did, and that new demand zone essentially created here was relevant to take some scalps from 26.8 to like 27.5 in this structure. And it's only lost, and you can do this, I'd say anything from the 4 hour above is good for looking at supply and demands. It's only relevant if it closes, invalidated if it closes below the level. And that's the thing that sticks out in my head, is that once it closes below the level on a daily time frame, it's not relevant. The moment it did that, don't care about it. I don't care at that point. I'm looking for, different structure. So with the supply and demand zones, we'll take this as an example, the supply that we had from the overall high. We have secondary demand, supply and demand zones. We have a second one here, right? So not just this one. We then have the next candle that came after, right? That one to that candle. So we have some overlap of supply and demand zones. And we have another candle there, which is essentially, this entire thing is potentially a supply zone, right? All the way to there. So what you get with this, and I know it seems like a lot of structure to be drawing on the chart. Let me see if I can drag it. What you're now getting is a lot of overlap of level. So what's your major levels that you're essentially looking for continued failure? Anything that fails to get above 30.4. So now this is kind of like in the same way that we use on the volume, on the auto charting tools, we use the volume blocks. When there's overlap of structure, we have overlaps of supply zones or overlaps of demand zones. So again, very, very relevant, very strong. And then let's just look at it going to the lower time frame as well. Going to the 4 hour, what do you see? You have a supply zone, first initial failure that creates a new low. The moment we created a new low, what do we look at in the structure? We're looking for secondary failure above. We got it. New supply zone created, fail at the level, move away. Price comes back up, creates another demand zone or supply zone, moves away. So you can see the more the stuff, essentially it's overlapping, it's creating more supply zones. This is not the same as support and resistance. Yes, there's a lot of resistance there, but because we're creating massive bullish and bearish engulfing candles, what that's actually doing is blowing out all of the local rate. Is basically it's an invalidation of the local structure. Like if price is coming down, right? So you have bearish candles, right? Or let's say we have bullish candles here, and then we have a massive bearish candle that fully engulfs previous price action. Does that not mean that that entire structure is relevant to continue to the downside? Absolutely. With support and resistance, you look at things that stack positions, longs and shorts in the same place, and that's why it becomes weaker over time. However, if you're continuously creating more supply zones or more demand zones on a higher time frame, you're now creating points for continued reversal. So going to the right in this entire zone, you've created multiple daily supply zones. You've got incredibly good, powerful points to short, and then essentially you can use these zones more broadly on lower time frames to look for failures. And that's very often what you'll end up getting. As you get the continued failure, it's still valid as a supply zone until it closes and breaks out of the supply zone, essentially flipping the level. So that's a little bit about supply and demand, and then looking at the swings as well and why those things are relevant. And in these things and with the swings themselves, you got to understand what we're actually looking at with the swings is that the fact is they're ranges. Everything is a range of a range of a range, right? So with looking at the local structure, when we have a major turnaround, I'm on here on the daily, I'll just mark this one as an example, right? We make the high, that structure there, right? High of the swing, low of the swing. What's super relevant here is that this is essentially a range, like this whole structure. So we'll go lower time frame, that's a range. Go lower time frame, that's a range. And in these ranges, you have failure and creation of new lows, losing ranges, right? If that's the upside range that we've now lost it, created a new low, lost the bottom of the daily time frame one. What invalidates the short if we gain back above into the major level? So with these things as well, you can look to use potential just range settings on a Fibonacci retracement, right? That's a very clear range structure comparatively to most things. Something like that. right? It's not going to be perfect. It never is, but it's pretty damn close. It gets us ballpark. You can still play the range or try to keep playing the range. And what it does is it keeps you honest and making sure you're taking profits on levels. So if you're trying to scalp these things on lower time frames, what you're able to then do is say, well, we close outside of it, we bullshit regain, I'm going to long, take my first PT, stop me out, still valid. I'll long it as it comes back in. First PT comes back down, stops me out. Is it still valid? Yes, long, two PTs, and then so on and so forth. And that's how you kind of can build between swings, supply and demand zones, and ranges. They all kind of work together in the kind of price action we really look at. So I'd say the biggest thing with this, is that we can actually have the ability to have multiple points of essential looking at failure, looking at like gain or loss of level. And that's like, even here on the 15-minute, this 28071 level is still super, super relevant. So from the 15-minute up to the daily time frame, the same level means the same thing. You have to gain that to go higher to test higher structure. So that's how we look at it from a sense of price action, supply and demand zone, and that type of thing. I'll probably do a couple more roundabouts about it, but initially, are there any questions on that? I know it's a lot of information and whatnot, but any questions about supply and demand zones, ranges, or swings in general? Yes, no, all good. Everyone's happy with it. So moving on from there, just to kind of like look at the structure that we're creating. Now that we understand a little bit of like why swings are tested, if you want to have the same things that I get plotted, like when I'm on the 4 hour, I use these plots they're very, very strong levels for me. All I do is I have my swing point set at bodies and not wicks. So because I want full retests, right? I want full retests and holds and levels that really give me levels like, hey, this is an important swing. That was the low that created. We bounced out a long, essentially creating a massive 4 hour demand zone, right? Still valid, still relevant even on the 4 hour. Did we hold that? Is that the major level? Yeah, that's why I plotted that on my other chart. That's like the major thing. We got the other long as we went into it just because what it do. The initial demand zone that's still valid is still in play. Then we have a secondary demand zone created, right? Then we have a third demand zone and a third demand zone created right here, right? So what do we have? We have high confluent zones of overlapping demand zones. Does that make sense? And it just essentially it shows you that it's not the fact that it's support, like individual support lines, but now we're creating high value and high demand zones, right? So this whole area here, let me just change my color so you can see it. This whole area here, right? This is a very high demand zone. Until we start closing 4 hours underneath that level, it's still valid as demand to go higher. And that's why you can scalp these ranges that seem untradeable, essentially, right? Because this area down here, the last couple of days and from the weekend it's been a rough zone. Absolutely, there's no doubt about that in my mind at all. But this is a nice little way, a little extra tool in your tool bag to essentially see major points that you want to look at as far as potential reversals, because those are your highest hitting plays, your highest returns essentially are catching reversals as well as you possibly can. And I think this is an easy way to do it. So even here, what do you have? Do you have a local supply zone? Yeah, you've got one above us, right? That's technically a supply zone. Do we have another one? Yeah, we have a local one here. Are there overlaps on it? No, not yet. So what happens? What can we use this for, essentially? Well, if the daily and weekly are on the same level and we're still not closing outside of the demand zone, we've actually now perfectly tested, look at the structure above, high of the swing, low of the swing, perfect test, low of the swing, right? Reversal. What do we want to do now for see a continuation? You want to lose the weekly open and the daily open to have a continuation down. To what? our major demand. If we flip major demand and lose it, we had supply zone here. That was invalidated the moment we closed above it with this candle, right? So what's the major stuff that's not invalidated? That's the stuff that you care about. Yeah, you're going to be some points like, okay, we're slightly out of it and then I gain it back. I mean, margin of error being 20, $30, I think that's still relevant, still valid. It's not going to be 100%, like literally. Again, I'm on a perpetual inverse swap on BitMEX. It'll be a little bit different on all the charts. But broadly speaking, we're looking at the supply and demand zones that are still valid. And that's what we want to see. Overlap of supply zones, overlap of demand zones. We don't really have that. But what do we have? We understand swings. We've tested that. That's the invalidation to move us back down to test the daily weekly open. Let's look at a lower time frame to see how relevant that is. I mean, on the surface, like just by itself, now you've created major levels for retests, right? That was the level you gained that took you to the high. That's the level you just bearishly retested. So what's the level if you want to test back at the highs to regain? 26,073, right? You want that gain on a scalp to test that high at the very least. And then you don't want to close any 4 hours above. Otherwise, it invalidates the supply zone. And then you go back higher to test other supply zones, major structure, and whatnot. But it's just an example of how you can use this stuff effectively. And and with this, we can always use these things on by themselves with our extra tools. What do we know about funding rate? Funding rate's still bullish. It's coming back in a little bit better after kind of dropping off in this zone. Not super relevant at the current time frame. What about this? We're seeing some breakdowns of large caps. Stable coins are moving up. And altcoins are finally starting to have a little bit of upside, whereas shitcoins are moving to the downside. And then obviously, we're pretty much running flat on the oscillator because we're in a range. We are in this range locally. So if you really want to use this, especially when you're in a really tight range like this, you can drop it down another time frame. Look at the 15-minute. Are the levels still valid and relevant? Absolutely. Each of these things is giving you good turnarounds. Failure from the high in a supply zone, down, breaking down structure, coming back to the downside, regaining it, back to the upside, test the major demand zone to the down, or the supply zone to the downside. Now where are we? We're sitting in no man's land, right? We've tested everything above that we need to test. This gain is what takes you back to here. Currently, we're looking at the weekly daily open because we're moving down. Trend and strength has started breaking down. So if we fail that, it takes us back to our demand zone. And that's all we're doing. We're flipping our bias over and over again just to catch the scalps, to catch the moves. And you can do these higher time frame supply and demand zones and see how relevant they are on the low time frames. Right? So, any questions on that? I haven't really talked about supply and demand zones in a while. Does it make sense? Is there any overall, it doesn't make sense? And this stuff here, it's essentially all I'm still using is the 4-hour structure, right? As for supply zones, it's very simple. You look at the bearish engulfing candle, then you look at the bullish candle. You take it from the low of the bullish candle to the top of the wick. That's your supply zone. It's the inverse for the demand zone, right? Massive bullish engulfing candle. You look at the previous 4-hour candle, you take it from the high of that candle, essentially where it opened, to where the low it created. And now you've got your demand zone. So the more you do this, the more you look at these levels, the more it'll start making sense and clicking as far as major zones. And then other things you can also use. It's not going to be as just poignant as pointed as just the supply zones or demand zones. You can use stuff like the volume blocks because it still gives you major levels like that but there's more filtering. So it won't catch all of the demand zones, but it'll catch the big ones that you look for, right? So here, massive volume bullish zone created, massive bearish zone created. Yeah, there's going to be some flip-flop levels. There's going to be some levels that are essentially very, very thick because of the look-back period. So my argument is turn it down if you want to just see what the important stuff is. And the more filtered you can get with it, the better. And then the same thing applies. You're looking for overlaps. Overlaps are really relevant when you have the volume zones. So there you go. Major bearish volume. We know that automatically it's lining up with other structure as well. We've got our supply zone locally. We've got a local demand created right there that's reactive. And when you have flip of level, treat it as such. Flip of level that takes you into some bearish volume. Look to move to the downside on failure of structure. You have lots and lots of supply, a lot of bearish volume blocks above you. You're failing major levels, failing to regain major highs that create these levels. And again, the more specific you get with the sensitivity to drive it all the way to the downside, you can use these, to continually filter out so you only get like the most relevant ones. And I think that's really helpful overall. So here you go, the most relevant essential ones. Here at the highs, what do you have? You have your major flip, you have some overlapping levels here. You lose the structure, you bearishly retest it, and you move away. Right? You've got the strong volume block bullish to the downside. It's still very relevant to the overall demand zone as well. So we know that that's the important level to hold. So does that make sense? Any questions on that? I know it's a lot, but the volume blocks are the demands and supply zones. I'd say 4 hour and higher. I think anything below, you could still use it below that for scalping, absolutely. But when you're going on lower time frames as well, I'll turn these off for a second. When you're looking at lower time frame volume or supply and demand zones, a lot of times you might get, essentially miss a lot of trades because of it, and you might actually not catch them at the highs because again, you're doing this at a very low time frame. So here's an example. I'm on the 15-minute. We have a nice bearish engulfing candle that takes us here. Let me just get rid of that. So again, the problem is because I'm here on the 15-minute, that's still valid, still relevant, right? It's just not as clean. You actually broke out and made a new high, then you failed, and it's still a valid, 15-minute supply zone. Is it as relevant as the higher time frames? No. It's always. You mean like tightening it straight up? That's good. I mean, it's not stupid. Definitely not. Definitely not dumb. So, yeah, you can use them on any time frame. You can use them down on like the 1 minute. I just don't recommend it because you're going to be seeing lots and lots of levels that kind of like step off and create zones. Like, you know, even here in the local structure, that's a supply zone created. Was there any chance to short it? No. How about the next one? Next supply zone, is that shortable on the 1 minute? Yeah, but what else is it? These are also swing structures, right? It's also, essentially failure from the high, failing local structure and coming back to the downside. So, can you use it on low time frames for scalping? Absolutely. Is it as relevant as higher time frame? Definitely not. So I would just say err to the side of caution if you're using it on very low time frames. Plus, if you're on like the 3 minute, the 1 minute, I think that's too low of a time frame. I think the 3 minute, yeah, you can scalp on this and do stuff, but you'll get blown out a lot. I don't recommend it. You guys know my position on low time frame moves. It's just it's too. Yeah. It's not even just that. It's like to really maximize on trades on these low time frames, you need to be like market smashing in and out with like very very high leverage to make any kind of percentage on it. So I just don't recommend it to people because it's such an advanced thing to be able to not only manage risk in the level, because you can just get liquidated instantly, and it happens all the time. And the guys that are trading down here with a couple $1 million, maybe they have like their margin on their positions is 10K, but they're 100xing it and stuff, right? To be able to actually restrict price, and this is a little insight into how market makers do it. What they'll do is they know that the market has changed from the last cycle, like the last bull run, 2017, 2018. the amount of new money that's come in, the amount of liquidity overall means that they can't move price like they used to do. They used to be able to just wreck people and essentially there was an old indicator that we all used called the premium funding, the BitMEX premium funding index. This thing's been around for a long time. This was literally all we used to trade back in the day, on top of a lot of other things. But essentially, the premium funding index told us, because BitMEX was the king, it's like the direction of the premium funding, whichever side is being, incentivized, was the way that the market makers would move price. That's no longer the case because BitMEX is largely not viable as far as liquidity. So what do you have to do instead? Well, you have to look at what they can do. So the market makers will find levels and important structure that they can restrict on low time frames. What I mean by restrict is, you don't want to essentially enter a position if price is going up, up, up. You don't just try and hold it there. You wait for it to start coming back down, and then you start actually entering position as, shorts are being liquidated. They look at getting their fills because they're filling at much larger contract sizes. The only way they can get fully filled into positions is with these liquidity grabs, right? These are all liquidity grabs. Why? Because price came up. Essentially, bulls are in control. Long. What happens here? Loss of interest from the bulls. Price starts to reverse. Shorts come in, and that's liquidity movement. Liquidity grab, comes back down, closes below, continues the downside. And that's how they enter and exit positions. They can only enter at at major liquidity. So when I say all the time that the market moves from liquidity to liquidity, that's because it does. If you want to have big positions, you can only enter them, if other people are getting liquidated. Like what happens essentially if they're in shorts and this little blow off, or here's a better one of the high here. If people are in shorts and then you get this blow off that blows way to the upside, people are filling shorts. How do people do that? Well, how are people in positions? If they take shorts, let's say there's in this area, people are shorting with a value of 10 million contracts, right? If they get liquidated, which causes this entire candle move to the upside, right? What's the effect of the market if they're shorting 10 million? Well, the moment they're liquidated, that 10 million, the market reaction is 10 million long, right? Because it's going up. So what they're doing is all of these buys are coming in. They're putting in shorts in the same zone. These essentially the guys who are getting exited in position and forcing the market up because they're getting liquidated in shorts. What's happening to the guys who are already filling shorts? They're getting all of the liquidity from the shorts getting liquidated to enter their shorts. And that's what I mean by entering at maximum liquidity. Because when that happens in the market, you get these major wicks to the upside, major wicks to the downside. So what they do is they say, I want to be able to restrict price. So I'll put, I'll look at the overall structure. There's some big stuff here. I'll put a buy block in here, essentially, of stuff I want to hold. Bang, 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 tight stops, that type of thing. So when price comes down to it, longs start getting liquidated. They get entered at maximum liquidity. The people essentially, the inverse of this is, the market effect is people are selling 10 million in longs. They're buying it up because they're selling their long positions, and this guy's buying them. That's the easiest way to explain it. If the retail guys or the other guys are getting exited out of their positions, they're selling their long positions into someone else who is longing below them. So he's getting entered at full liquidity to go back to the upside. And these kind of percentage moves, when you're getting 0.3 at 100x, these aren't inconsequential. These are significant gains in overall price. And down here, that whole percentage stuff is a big deal, right? When we talk about percentage of movement. So most of these guys don't even look at percentages at this low time frame. They'll look at overall dollars, essentially, how many dollar movements up, or how many lines, essentially. But I guess it is still percentages, but the whole idea with this is that look at the amount of volume in this area, with the new ruler function, right? There's $15 million in volume logs just on BitMEX. That's the volume since since around 1530. So what is that? In an hour and 15 minutes, $15 million in volume. And that's not a whole lot. That's a very small amount for an exchange nowadays. So what's happening? Well, if they know that people are entering longs at 15 million and they want to start breaking the longs, right? People getting liquidated out of position. What do we know if this was like the midpoint of this range, right? Because everything's a range. We'll kind of just take a little ruler and say, well, where's everybody getting liquidated at? Anything that comes into the lows, right? Anything over about 0.65, 0.7, 0.75, you're liquidating 100x's, right? So even these little movements are not a whole lot comparatively, but why do we have stuff like reversals that lead to major like wicks to the upside? Because people are shorting this stuff, right? People are shorting. Oh, we broke levels. We're shorting. We're going down. You know, I mean, that blow off there was essentially all of the major shorts that were down here getting liquidated, filling, and that's 6.5 or 7 hours, $68 million in volume. At least half of those are shorts from down here getting liquidated. Let's say it's just the local stuff down here. $34 million in volume shorts. Is that enough to move price up from 2640 to 2680, $40? That's what it took of getting liquidated to move that amount to the upside. Absolutely. So what do you know? We liquidated people to the upside. You fill major shorts. You move back to the downside. You've created some low time frame supply and demand zones, and essentially they were able to take a major profit target, with that retest of a higher time frame. But that's just a little insight into the way whales thinks. It's like, they don't look at the price action structure like we do, because they're looking at it from a perspective of liquidity, and liquidity essentially is just doing this. If this is like the 100x liquidity curve, right? That's the way they're kind of like looking at the overall market. You start breaking into the stuff, you're getting liquidations. But we do have something we can use for that, right? Even on low time frames. What's happening in this zone? Even though they were below the bands, we're still in a band zone, right? That's still valid and relevant to the overall price. And this is low time frame, so we haven't really shared this a lot with people, but see how effective it is looking at low time frame reversals using the band structure, because the band's gonna be constantly reversing. It's not perfect. There's still gonna be levels that you get wicked out, come back in, go back to the upside. But overall, if you're in a low time frame range like that, they're looking at this stuff as far as it being, reversal areas for liquidations. And on and on and on. And there's other things we can use too, right? We can use the volume delta on lower time frames and tie that into everything. I don't like it on like the 1 minute. I think it's too much, but you still get stuff like this, right? Shorts out of position, reversal, point of control, not super relevant at that low of a time frame. But is it still relevant even on the 3 minute? Sure. You can absolutely use it. Shorts out of position, or shorts in position. Price moves away. Failure. Shorts out of position. Price comes back up, bounces. Continuing. Until we start losing this block. That's the block to hold. And then move away. Longs out of position. Failure to make a new high. Price coming back to the prices back up to the upside. This is why the low time frame scalping, again, you're gonna have a high you're not gonna have a high win rate a lot of times with this stuff. I would much rather recommend people doing higher time frame stuff. But the easiest ones to trade with this are essentially just major liquidations that leave a lot of volume out of position. If that's the volume that's out of position, they're pretty much screwed at that point. Any questions overall? I know it was a lot of information. and it's a bit of a different one. It's a bit of a difficult one. A lot of times getting used to it. Yes, no, we're all experts. I like it. Any other questions about anything else you guys are interested in? Well, I got some time now. Egil, you got anything? Maria, Nasonics, like Alex, anybody? No? What? From what? I mean, yeah, yeah, currently. And then, you know, that was out of position essentially. Lots of bullish volume out of position. We had a strong bearish candle to move back to the downside. We can use other things with us, essentially to say, okay, we're starting to see some trend change here. That's the initial failure of strength. That's essentially creating us, essential levels that we want to see failures continually of, right? Swings are still valid, but we're holding the point of control. As long as we hold the weekly daily open, it's up. If we lose the weekly daily open, where do we go? Go to the low of the structure. I think that's very possible. I think everyone is just looking at this like, oh, they're only going to rate. They're not going to raise it. It's going to be up only. And what do we know about news things? Is that it rarely does what you think it's going to do on the news. The forecast is that they don't raise interest rates. That they have no change in interest rates for the first time since the data that came out today has been quite strong. Like even PPI data is way down. Yeah, that's a very strong. Yeah, yeah. I think there's a pretty damn good reason to squeeze the upside, and that's been kind of my plan. Why we talked about it yesterday, right?
Hey guys,
What's up?
sorry, I'm at work, finishing up
No,
that work and get home to the FOMC meeting with you guys. Um,
no worries.
uh, Very quick, if you don't mind, Chris, just to if you can slowly that way, I can just write it down. The bearish engulfing candle to the left with the with the high line. You draw a line at the low of the candle, close to the top of the wick,
Yeah,
right? Okay. Is that all right? Can you but I'm having a hard time putting the bullish engulfing. Can you explain that one more time, please?
yeah, no worries. Absolutely.
Thank you.
So, bullish and bearish engulfing candles. Like again, we'll look at the two that are the most relevant in the structure. We have this one here from the 7th and this one here from the Monday, Tuesday, that evening, right? So we have a very clear, I'm on the 4 hour, higher time frames are always more effective. You have a bullish demand zone created. Why? Because we have the bullish candle that fully engulfed the previous essential range, which is demarked by a down candle. For an engulfing candle to happen, the previous candle has to be opposite. So that's a very clear bullish engulfing candle, right? So you draw the demand zone from the open of the previous candle to the low of it, and that's a demand zone. That's a bullish up demand zone, right? Supply zones. You have a bearish engulfing down candle when you had a previous up candle, right? That's obviously bearish engulfing. We take it from the same thing, from the candle open, but to the high of the candle. And that essentially is your supply zone. So uh, supply is down, like bearish, demand up, bullish. And so that's demand zone, supply zone. And when you stack these things, right, they're always valid until you get a close opposite to it. So in this supply zone here at 27K to 2770 to 27350, that's still in play. Have we closed anything above it? No. Still valid, still relevant. So I'll just kind of scooch that sucker all the way to the right. Go for it. Because this, what do you mean? You mean this? because it maybe didn't have enough volatility. Like the swings at auto plot. Yeah, so if you're using auto charting and you're using the swing points, there's a volatility requirement. There's a volume requirement. And if it's low volume, you can still argue that it's an important swing, but it's less relevant. So that's why we use a lot of volume and volatility filtering on some of the strategy stuff we do. Because if you don't do that, you'll get like fake pumps and fake dumps that are low volume. And it's the high volume stuff that's more relevant in the overall structure. If that
So
makes sense.
oh, sorry. So Chris, basically, that supply and demand close. It's more similar to what you taught us about swings, right? High the swing, low the swing. So
Kind of. Like
yeah,
you're going past it. You're going past it. So like in this same zone where we have a supply zone, we have that which is the low of the swing and that which is the high of the swing, which is still valid, right? That's
yeah.
still swing structure. Yeah.
My question to you, like, if you basically charting something, and they all fall on the same category, because we know that the swings, you look at the candle to the left, and if you plot in supply and demand, it falls under the same, same candle. From like, because I wrote it down here, you said uh, from the daily time frame, it needs to be, if it's a lot better if it's relevant going down to the 1 hour. So if they fall both at the same, same spot, kinda, is that like an extra confirmation
Oh
to
yeah.
take
The
that
more
trade blindly?
yeah. I mean, you never. Well, don't use the term blindly, but yeah,
No, no,
it's
because like, because I know those are like, it's a high effective rates. Those the high the swing, low the swing. Now, when you plot in supply and demand like those, when you have both at the same spot, I mean,
yeah.
what I'm thinking about, like, what would you want to need extra confirmation or look or something else if you have both stacked up at the same spot? I
Exactly.
don't
Well,
know.
that's what it is. That goes into the overall strategy that we kind of we create with Trendmaster is we're price action based, but we use confluence. Confluence meaning the more confirmation of different signals and stuff tells us there's a better chance that we will do what we want to do essentially, right? So what we're doing with that whole thing is and you're right, you're absolutely right. The more levels that we have confirming, that's an important level. That's also the current month. That's also the failure. That's also a previous, you know, supply zone, right? We have multiple supply zones in this area. We've got that one there, essentially at the same exact level. So all of these things kind of stacking at each other says, well, if that's a 4 hour failure, but we're moving, up above it, right? We don't know what's happening. Is that super relevant lower time frame? Absolutely. So the more you have man, the more you can use these things as far as entries because they're still failing at structural levels. Like, even here on the 1 hour, is that not a flip of level, right? It is. It's essentially that move up created a local high. When we failed it, it went back to the downside. What else do we have with this? I mean, like this is just very clear, closing below, bearishly retesting structure higher, coming back down, creating more lows. We broke above, bullishly tested, failed, came back to the downside. What do you have with this zone compared to everything else? We've got some more essential supply zones, some more potential levels for shorting. And we can use everything else with it. Like when we have the lower time frames as far as getting up into these levels, even on like the 1 hour, right? When you have swing points that are relevant on the 4 hour and the 1 hour, they're the same level. Obviously, that's going to be an important level. What else is it? It's also the June. It's also a previous supply zone that we didn't close a 4 hour outside of. So it's still valid as far as a 4 hour supply zone. So failure, secondary failure, peaking on the oscillator. What else do we have? We have some very high, very what is it? Very low retail stablecoin demand, right? This is still my favorite thing from the on-chain metric bundle. You just take retail stablecoin demand, you invert the chart so it'll go with the flow of what you're looking at, and then you just put divergences on. So what do you do? Well, this is measuring real time on-chain demand from retail, which is like below a certain number of coins. If they're heavily getting into stable coins, because the stable coin demand gets green very high, what do we look for? Higher lows. We had one little liquidity grab before we stepped off, and that entire thing essentially, price made new lows. Oops, it's a text box. Right, here's a great one. Price made new lows, but this diverged to the upside. It's not going to catch it every time, just because that's. But you can use your eyes to see that stuff, right? Lower price action, higher demand, or in lower retail stablecoin demand because price is going up. We get to the peaks, right? And we can overlap these things here. I can even turn off the demand, the divergences of that, and just leave on the oscillator. Is there not multiple levels of confluence? Yellow dot says what? It says that we're starting to reverse. Blue dot says what? We're starting to change the trend. Stablecoin demand is starting to go from very, very low stablecoin demand to increasing. We're seeing the strength and trend changing. We're failing at a major level. We're failing at a demand zone. We're failing at a swing level. You've got 5, 6, 7 levels of confluence. You've got a breakdown. Here was the peak on the flow index, right? The peak was essentially here on the flow index, right? And then what do we have here? Divergence. The flow is breaking down, and we make a new high to fill at the major levels. So now you've got 1, 2, 3, 4, 5, 6, 7 levels of confluence to take trades, and that's how you get those high probability hit rates. That's essentially what you want the most of, is the highest amount of confluence. You don't need everything. It doesn't, just because that was a great example of everything being hit. Failure to major level, failure to supply zone, failure at the swing, stablecoin demand, harmony oscillator. They gave us like 3 things. The flow index showing a reversal, stablecoin demand increasing, or stablecoin flow going up, large caps going down. You're trading Bitcoin. How about funding rates? What was going on with funding rates? Funding rates are coming up. What do we know about funding rates going up? It's going from negative, which is very, very heavily incentivizing longs, to decreasing. So when they're decreasing and prices going up, you know that there's a potential reversal. If this was increasing, right, as price is going up, you could have a higher chance of continuation. Price breaks down, high retail stablecoin demand, increasing funding rate, right? What else do we have? We have breakdown of the supply of stablecoin structure. We have increase of large caps on flow. And what else do we have? Higher time frame. This is essentially like we're creating demand zones on top of swings, on top of levels. Does that make sense? So you're using everything that you have available to you, but you don't need everything to confirm a position. I mean, even here on 4 hour, I gave you a bearish divergence just on retail stablecoin demand. If that makes sense.
Chris, for the funding rates, we invert the colors, right?
Well, yeah, if you want to, I do,
Yep.
just because I
Yeah.
like obviously negative is default red because it's red, but I look at it because funding rates being negative are bullish. The incentivize, if you ever look at when you're taking positions and you look at funding rates and it says shorts paying longs, it's because the funding rate is negative and going down. If it says longs paying shorts, that means the funding rate is positive, like it was here. That means shorts are being heavily incentivized at the high.
I got a question for. So if you're just sitting in front of the computer, you're watching the charts.
Yeah.
How do you know a leg grab while it's happening? How can you identify that precise? Any kind of, not exactly, just to the telltale signs to look for when there's a leg grab is happening. Because I know you said uh, big market makers, they try enter at maximum liquidity.
Yes.
um, what if you're just watching a chart and you see that happen? For example, Ray, it's famous for that, plus a lot of shit coins. So what are your telltale signs um, to identify a leg grab while it's happening? And is it a good thing to kind of try to compete with the big boys and just get in a position there at the top or the bottom? I know that's not something that you advise on, but is that something that you exercise before?
Well, that's the thing. I think when you said compete, I would say you want to trade with them.
Yeah,
It's like,
yeah,
yeah,
rather.
yeah, that's absolutely valid. But for that to happen, you need to make sure that like you're not getting suckered out into their position because they're very good at making people think different things psychologically. like psychologically breaking retail is, I mean, I've had conversations with a lot of these guys, and we know we're friends with a few of them, and I'm telling you right now, they literally look at retail like we're all like plebs, and they're like, oh yeah, we just want to like punish them and break them. How do we, what's the general upside movement in the market? It's essentially just the price will only go up once they've broken retail to start shorting, and then retail starting to short as price moves up means that they've broken retail. How does price go down like it did in this overall structure, right? We're above 30K, yay, we're going. Oh shit, we have a major movement down that broke structure. We came back up, oh, we're continuing, bang, off a cliff, failure. We broke the structure, we're looking for a short to continue back to the downside. Same thing here. Oh, we're going back up, we're here, we're about to retake 30K, right? Failure, failure. All of this became giant liquidity grabs. And what you can do when you're looking at this stuff, even on like the the hourly or the lower time frame, when you see major uh, wicks that end up in reversals of price, right? Price, we created a new low, but closed that candle back above the previous candle's lows, right? That close was above. If that close had been below, not really a liquidity grab, right? Here's an even stronger version of that, right? Here's the low that we create. We have a nice pop back up, slides back down, blows back up to the upside, comes back down, creates a new low, but then it's still bought back above previous low structure. What does that tell you? It means long liquidity was grabbed down here. And you can use,
So
I mean, you can use the core trend
yeah,
thing as well.
I love that. I love the bands on Cortron on the 15 minutes, especially. That's just so
Oh,
so when you see those blow off tops and you're watching the candle, the countdown, um, so you wait for the countdown to finish for the candle close and move on to the next candle, and you try to long the next candle because knowing that lick, it's rare when the price goes all the way down to where the lick happened.
yeah. So if you're trying to catch the actual like the close of the candle when you're looking for the close of the candle, that's really important because you're seeing essentially that the price action has changed, that we've rejected or supply or we rejected demand, that type of thing. So what you're essentially looking for, like here you have some liquidity grab lower time frame. We're at a bands high, which is fine, but essentially what you're doing is you're looking for the low that creates new low structure. If you're trying to short into the highs, you damn sure need to make sure that you're shorting. Essentially, everyone trying to short the highs because there's like, oh, we're going to go lower, we're lower than this. What happens? They cause all of this liquidity to go up, and the price started reversing. And then as soon as here's an example that I like on the 15-minute. You see that high that we created with this 15-minute candle?
Yeah, that you can't do anything about that candle.
Well,
Yeah.
let me show you a lower time frame. So we'll go on the 3-minute, go back to the left, turn these off. That structure there, where could you first have tried to short this thing? Do you want to short at the highs? Once you do that, lick grab the upside? No.
So the next candle,
How about with that swing?
yeah, got it. Okay. All right.
And the
Thank you,
next
man.
one.
Got it. Yep.
Does that make
That kind of
sense?
confirms what I was. Yes. Yeah. Thank you, man.
Yeah.
Appreciate it.
And so now you're breaking structure to the downside. Yeah, it's still fighting to buy back, but you're still failing, right? You're still failing, and you've had a major blow off to the upside, essentially blowing out shorts. People are entering at maximum liquidity already above you, and they want to be able to take profit. So what does that mean? That means that they want to push. They have an incentive to push price away from it. Longs are exhausted, shorts got blown out, and now the whales, essentially the market makers, have gotten the free ride to the downside. I'll just turn that off real quick. This is why, like, when I talk about perfect price action, I mean literally to the
To the
dot.
yeah. Yep.
Like that's about as perfect as you can possibly get, you know. There's nothing like it. And I mean, I'm on the 3-minute here. You see it on the 1-minute. That's how you know if a level is really important, is because it's respected on multiple time frames. Pop up, fail back down. Pop all the way up, sold back down. Pop up, sold back down, and on and on and on. And that's about as close as you can get to actually shorting a high, like something like that. Because anything, if you're trying to short higher than that, you're playing with freaking fire, man. Like, because this thing could easily, even here, on the next candle or two, it could have easily just popped back up and failed like that and blown your position out. Which is again, like I like the 3 minute over the 1 minute for that reason, because I think the 1 minute is just there's too much that can happen on such low time frames. But the price action doesn't change. It just things move faster at lower time frames, which obviously, I mean, you get new price action structure all the time. Here's one. You had a close back below. Nice lick grab to the downside. The liquidity grab actually tested some structure, some previous highs. Not too relevant, but buys back up, close back above. That's liquidity grab. That's liquidity grab, pretty decently. That's liquidity grab. That's definitely the big liquidity grab. And that's all it is, on and on and on. And now you're seeing there's some big players right here that are incentivized to restrict price. Because with market makers as well, they don't just take one position one way. What they can do is that if they're entering shorts above you, so like here's a little interesting one. I'll just draw this box. Let's say they're entering shorts above you, right? What else are they doing below you? This is called a restriction that they put in on price, essentially, right? They've essentially trapped people with this kind of structure. Now, these aren't demand zones, right? But why are there restrictions? Because they're buying price back up in this level. So you're in a restriction right now. When a restriction starts failing, it means they're not interested in, and they'll play both sides. A lot of these guys, A, they're coordinated, B, they have big bags, and if they know what they're doing, they can put little restrictions in like this. And hey, how much was actually, volume wise in this level? In that little period of time, that little, 1 bar, it's $2 million in volume. That's a big guy. That's potentially one major dude with a lot of smaller retail. How about this one? This will be interesting. 2.53. So very, very close to the same amount of volume on both sides. So what do we know about hedging? Can you hedge that amount? I wouldn't, because I don't have a system that allows me to smash an entry and automatically plot, a stop loss. Like some of these guys' systems, these are six-figure custom softwares that they're running on their computers that allow them to hit different keys, and they're like macros that allow them to do this stuff. So what you're looking at essentially is like big guys putting in restrictions. What happens when a restriction starts failing? Well, it's when you start losing the levels and losing the restriction. That means that essentially the shorts that were put in here are fine. This guy's exiting his longs essentially, and by the time it goes away, that's all they're trying to do. They're trying to make money both directions and at the same time restrict price, which does what to retail? It traps people. Traps people who are trying to short this range, and traps people who are trying to long it. And whichever side builds up the most liquidity, that's the side that they're going to incentivize to essentially take the money from, based off of liquidity. And that's literally the market in a nutshell. Price going from liquidity to liquidity based off of taking the most amount of people, allowing market makers to enter at maximum liquidity. It's kind of not fair, but I mean, if you understand that, you understand the market is essentially, not even, it's inefficient. It's not, you can't just apply perfect like macroeconomics supply and demand exactly, because it'll go to liquidity, because there are people who still have enough, they can still affect it. They can, one of the guys, he talks about flicking dominoes. He's like, I don't move the market. I restrict price and like flick little dominoes. And the little domino effect is, well, if we start essentially seeing that, well, there's a lot of longs that are getting a free ride in this, from the low we made yesterday, right? So what's happening? It's like there's quite a bit of longs in this zone. How are we looking on volume? From this low structure up to where we are. There's about 200, a quarter billion in volume in this area. At least half are longs, right? Is there enough liquidity if we start breaking to the downside that we can move price back down and actually hurt people and take money? Absolutely. And that's the way they look at the market. That's the overall kind of way is where can I take the most amount of money at all times by entering my positions at max liquidity, right? We break a local high, liquidity grab, close back below. Look at the wicks. I mean, the wick structure alone is a good indication. What are we seeing here? A lot of restriction because the price is getting sold down, right? What invalidates that? Essentially breaking this structure. Do we see a lot of restriction moving price away from it? Absolutely. That's what it is. Does that make sense? I hope. Yeah. So I mean, it's an interesting one, and I think especially because I'm gonna do the other stream again tonight. That's gonna be the biggest thing that we can kind of keep an eye on as far as the overall structure, right? Looking at what the FOMC actually does, what the overall essential structure of it is. So I still think it's just gonna go, $300 up and down. We might just dump from it too. There's no way to know exactly how it's going to react. But the macro is if they don't raise interest rates, then I think there'll be a bullish effect. But looking at where we are now and looking at, say, stuff like the dollar currency index breaking down, continually breaking down, making new lows, failing back under levels, getting really close down here, some major stuff. Um, oh, if we go under 100, dude, like, and I mean this in all seriousness, if we go under, yeah, if we break the lows and make new lows, we're gonna go to 99, like 99.36 or something like that. We're going down to this structure, and you're gonna see just an absolute like rip face melting rally probably on everything. Ah, man, I mean, look at here's the 4 hour structure. I mean, we've done major 4 hour moves. I mean, this was one of the this parabolic break on the highest. This is an 18-month parabolic break that Will and I pretty much called to the dot. We were really happy with this back in October. We said, yeah, now we're gonna have the bear market rally. Not quite high, restrict down, fail, creating new low under the previous low, secondary failure, new low, bang, done, absolutely over. Bear market rally. It did it for TradFi. What happened in the same exact point? You had the FTX crash. So crypto got punished and went down further. So all of stocks are rallying in October because they're inversely loosely correlated. So look at the time, mid-October. Let's look at stuff like Tesla. I think Tesla didn't do its move until December. Yeah, so even in October, what was it? Yeah, this is not a good example. October, yeah, had a little bit of a pump, failed. It was very overpriced, but it was the end. No, it was the indexes. That's what I was thinking about. Because we're looking at general market, right? Look at the general market of the indexes. Where was the low? Mid-October. Where was the low? Mid-October. What was the confirmation of up? January. Confirmation of up here. I mean, you could have argued January, but it was probably for the S&P because it was leading for a while. Probably even later on in October. But again, like, what do we know about the local structure? Like, what are we doing? We're parabolic. Everything is going to continue until it doesn't. If we're parabolically up now, eventually we're going to fail. The crazy thing, like, it just, spitballing crazy, is if he comes out and says we're still raising interest rates, just nuke everything. That would be freaking hilarious. But the big thing to remember is that, TradFi markets are looking strong. They're looking good comparatively to crypto. But what do we know about crypto? Crypto doesn't respect the same things during the same period of the transition year. Why? Because we're in a transition year. This is what people don't look at. They don't look at the fact that Bitcoin and crypto overall has halvening cycles. That's why Bitcoin, like, not to sound like a maxi, I'm becoming more a maxi the more I stay involved in the markets because I hate TradFi. I think it's a scam. But overall, what are we doing? Bull run, bear market, transition into the halvening, into the bull run. Bull run, bear market, transition into the halvening, bull market. Bear market, transition. When's the next bull run start? When's the start of the next thing, the next halvening? It's a deflationary currency. That's the entire point. So we know that in the same period, if we look at that and then we look at the S&P, not similar. There's times where Bitcoin outperformed. There's times where the S&P by percentage outperformed, especially in transition periods. So it is what it is. But I think I'm going to end it there unless there's anything else. I do, dude. You've. I have no idea what's going on here. Yeah, I have no idea. Dude, I was looking at that earlier. I have no. That's dominance. I have no idea what's going on here. Not a freaking clue. I think there's an error. This is they had an error. I left this marker in, but if you remember back on May, the 8th of May, they had like the same pump, 77 billion, and then they removed it because it was calculating it incorrectly. So I'm assuming it's an incorrect calculation until. Yeah, I don't know what's going on with it. I'll be perfectly honest. It is stupid, and I don't know why they're doing it. Yeah, I still have no clarity about what it was exactly. Uh, well, yeah, but then we'd also see things actually pumping and moving. Yeah, bolts are still moving though, pretty strong.
So, quick question. So, when if one of these indexes are moving, like Eagle said, DeFi, total DeFi, so you you start to look for those individual coins to see if they are actually moving or not.
Yeah, but I mean, what like we were saying with the total DeFi, like something's going on. Like, there's no way it's just within
No,
one
no,
candle. Yeah,
on a regular day.
yeah.
No, no, like on a regular day. If, like, for example, DeFi is up, do you look for like DeFi coins to trade that day, or how does
Oh
that like?
no, I mean, like if it's already
No?
moved, like that's the whole thing. It's like if it's already moved, if it already did the move and it already like gained X amount of percent, it means the move's already happened. But you can look at totals
Oh,
generally
is
as the
that what
exact
we have?
same.
I'm sorry, isn't that what's the crypto flow index is for?
Well, the crypto
We could
flow
just tick
also quantifies the flow of money in and out of it, and then
flow.
shows
Okay,
like how
that's two different things, right?
yeah. It's a bit of two different things. So if we look just on the flow as an example in the current structure, like what you're seeing essentially is the flow score of like what's outperforming other things. Like shit coins right now are pumping, right? Lots of shit coins are pumping, small caps, micro caps, that type of stuff. Compare and leading on top of other things, um, better than large caps and everything else. So what our first thought is like if you're not already longing from the lows like what we did on Saturday where we talked about that, saying like hey this is a good demand, we're going to see some structure gain, everything else dumped. We had some good gains back overall. Have we gained anything back super important? A lot of alts? No, not yet. But what you look at is the flow score of like how it's performing compared to the rest of the market, and then the correlation. The correlation is the market correlation, which is what is the overall market. And obviously, stable coins are going to be inversely correlated to the overall market. The highest correlation would be one, and large caps have the highest market correlation. Altcoins have a very high correlation in the market and a good flow score. So alts are still doing good. Shit coins are having the highest flow score but they're not as correlated. So what you're essentially seeing is once you have essentially changes where you see stablecoin breaking down, right? Stablecoin flow breaking down, and large caps and shitcoins and altcoins breaking back up, you're seeing a big change in the market movement. And that's what you're seeing here. So the flow score is as high now for shitcoins on the 4 hour as it was. I mean, shit hasn't been higher for a long time. So it's probably getting near the end of a market correlation. That doesn't mean that the market's going to move down. It just means that other things, like maybe if stablecoin keeps breaking down, maybe you'll see the flow back into like large caps and stuff. Yeah, like memes and stuff. Like, oh, but speaking of memes, I just want to look for shits. Oh, I'm not. I'm so grossed out by that stuff.
Dude,
Oh,
I
the
took a little
Ben.eth guy.
I took a little gamble on this Floki CEO just a couple weeks back, and it's just been taking a fucking hammer ever since. And I'm like, when is it gonna move up? Right, today is like 48%
It's
up. The
not. It's
next one
going.
is
Yeah, I
yeah,
mean,
I
like
know.
that's the thing. It's like these things are for shorting.
Huh? No, it was on. It was a 2x. It was a 2x. I didn't even put a stop because it's like a $50 gamble. It was like, and it went. It was down 90%. And this morning it went 50% up. I was like, okay.
Yeah, I mean, but that's the thing. It's like you use the word gamble because that's what it was. Like that. I mean, realistically, that's the best way to kind of look at it is that you understand like doing that is not trading. That's gambling because there's no fundamental or technical side of it.
Yeah,
That says,
nothing. Yeah, I agree. It's just like you see Pepe sometimes, and you know how it was like Floki CEO. It seemed appealing to me, so I was like $50 in there, whatever it is. But I remembered something small you said like a couple streams back. You said if you keep investing in shitcoins, it's really you deserve to be burned. So I got that stuck into my brain.
yeah,
You know what I'm saying? You remember that when he said that, I was like, oh shit, that's me. Even though it was a $50. Huh? I bought it right up the top, like the top that you see there. I was like, you know what? I'm just gonna let it ride. But it just kept going down and down for like,
yeah. I mean, that's the thing. Like, these shit coins are designed by these nefarious people, like BitBoy and Ben.eth and all these other people that are
see that?
literally
Yeah,
using their own. What they're doing is they're using their own influencer base to take money from them. Because
he
I
came
mean,
up with this. He came up with this. Saw Ben. He named it after himself. How much fucking shallow do you need to be? And he tried to explain. It was this Instagram videos. I'm just laughing. How the fundamental is gonna change crypto is gonna do this. What the fuck are you talking about?
yeah. But I mean, this is on spot, right? I mean, look at the volume. Oh, that's not right. I mean, let's see from the lows here. What does the volume look like? Yeah, that's so wrong. Something's oh, that's it's they're counting it in trillion of that because they can't. They're not getting the volume details. So they're trillions of Ben whatever token. Like the problem is that so many people got burned on this thing, and like if I just take it off log, like you see how bad it was from the people who got. Imagine buying from the highs and the thing's down 70%, and that's just from a listing on a smaller exchange like BitGet. I mean, yeah, I don't know. To me, it grosses me out to no end that people that you would do that to your own base. That's the craziest shit in the world to me, man. Then they just abandon it. Then yeah, then they just move on to the next thing.
And very quick, so the flow is where the money flow is. The correlation how the move to other coins. So whenever you have both of them close to one, that's a good sign, right?
Well, I mean, with the flow index, you're essentially saying is that the market correlation of one would be perfect. So if we know that large caps
Okay.
are the majority of the market, they're going to be highly correlated to the market movement of crypto. Altcoins that are moving and shitcoins are moving similar, have higher correlation values, are going to be, more effective essentially, or trading better in that area. And then you can use it from different time frames. So like from the 4 hour, we saw that the flow was quite good. Even here on like the 1 hour, shitcoins flow score very high, performing very, very well. Even though price is starting to break down a little bit, this is still going up. That's why we see shitcoins still performing quite well. So essentially what you're doing with your flow score is that you're looking for breaks in the individual stuff. um, Let me see if breaks in the individual lines. Like I have it set on line now. If I just reset it to factory settings, the reason these are kind of interesting is that you can kind of see where they're breaking down essentially. Like stablecoin, here's where stablecoin broke down and essentially lost structure. And at the same point as that, we're actually creating higher lows on large caps, creating demand zones. Large caps also at the same point, like here, literally this bar, we went from a low bar to a pretty high bar, and we didn't gain anything back significantly, but we saw a significant change in the flow. So what does that tell me on flow? So I'm interested in like this area right here. Like as long as we don't go below that, we look to long to continue. On shit coins and small caps, you can do the same thing. I think personally, like just because you can do the same thing with the lines, it looks a little bit better. So just changing those to instead from a step line to just a normal price line, because I can still use the same exact kind of mentality, which is okay. Well, if this bar down, the large caps got punished, and then the next candle, which didn't gain anything back, actually created some higher low structure. Like that's pretty interesting to me. How about the stable coin breaking down, essentially creating new lows, or breaking down in this candle, and in the next candle they broke down enough to where we're actually losing stuff. So from there you can kind of use that and be like, okay, that's the interesting structure for that. So now, as long as stablecoin doesn't raise, higher than that in the local area, I'm not expecting a major dump. Like shitcoins now have been going strong, gaining level and structure since I guess this candle. So even though we had a little bit of a move up in the last couple hours, shitcoins have been performing very well, comparably. And you can use it on low time frames, a high time frames. It'll calculate it based off of that, or if you want to have it set to like trade at a higher time frame data, so you can have it on like the 1 hour, and then you put it on the 4 hour by just hitting higher time frame data. Yeah. So then you'll be able to see here. It's like, okay, this candle closed. By the time that candle closed, you see that the higher time frame changed dramatically, right? And it's failing levels, and stablecoin is going up. Like obviously, you come back down to major support. Stablecoin fails again, going back down. Large caps gain back, create higher lows, and continue. Large caps overall don't have a high flow score because why? Because Bitcoin and Ether are in like perpetual ranges. But shitcoins have been doing quite well, as we see on some of the some of the percentages overall, comparably. But eventually, it's all going to fail. Like even here, shitcoins are starting to turn around and come back down on a higher time frame. So we'll see. The next 4 hour candle closes in, I don't know, what is that, 28 minutes. So we'll see what happens if this thing's actually, if shitcoins start breaking back down, because now this is showing it on a daily time frame, and stable coins are still going down, large caps are still going up. So there's still some opportunity here for some continuation. We just don't want to see stable coins start increasing and large caps start decreasing. Oh yeah, like low time frame is gonna be wild, I'm sure.
We need to do some kind of a friendly competition. We do have a lot of stuff to use. and each one of us would just come up with two or three things they use constantly to make trades to see which one is best. Um,
Yeah, I mean, that's the thing. Like open source strat, like we're very open source about the strategy stuff, which is like if you got something
yeah,
that explain why it works, and let's see if we can repeat it. Because at the
exactly.
end of because at the end of the day, the only thing that matters with any of the trading stuff that we do is it repeatable and is it consistent? And it has to meet those two things. If it's not repeatable and consistent, it's not trading. It's essentially either you're trading an event or a one-off or it's a gamble, and that's not an effective strategy as far as like your positions.
I've been using a lot of the MDVD and
Yeah, me
auto
too, man.
charting a lot. And as you can, I try to post the breakdown why, when you go to profits, I sometimes I take pictures of why I entered the trade, and it's very ruthless. Um, I'm not gonna lie. I love
Yeah,
that, especially when it falls down under a level where it's like you have the daily open or weekly open or quarter open or something like that, and you have that point of control there. They all follow the same cat, and you just throw in harmony. That's like boom, 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 done. You don't have to
yeah.
look twice.
That's confluence, man. That's all you're doing is you're using confluence the way it's supposed to be used, which is
Yeah, if I nip this to the bud, this whole supply and demand thing today that we did, and I can get it drilled into my brain and add that to like every 7, 8, 9, 10 hours a day that I'm in front of the computer, I think I'll be all right.
yeah. I
I'm
mean
not gonna.
that's the whole thing. It's like the hardest thing in this, especially in ranges like this, is people are impatient. Like it's so hard to get good positions sometimes when even then it'll give you some kind of false stuff even on the 1 hour because nothing's perfect. Like it'll still give you deviations, but when you have stuff like this, like what we did Tuesday before the stream, that's how I was like, yeah, I think we're coming down here while that we were streaming because that happened because we broke down and lost structure and lost levels. Right, this started turning down as well. Stablecoin demand started turning down. Flow index as well. Breaking down a little bit. It's just
When you guys have
it's
time,
multiple levels.
I know Alex, he's a fan of this too. Do the core trend on the 15 minutes bands. Not right now. It's going to be a lot, and then try to see the MDVD as well, and try to find those various volume and position, and vice versa.
I mean, yeah, there's one bullish volume out of
Boom,
position. Test on
right
the
there.
bands, closed, done. What do you mean?
Well, that's the 15 minute. I don't know. Don't look at the trade before it, the long position. Yep, right there. Where would you put your stop loss if you just for hypothetically you entered at the higher low right there? Yep. Where would you put your stop loss? Just, as an example.
Probably there. I always front run my candles because I don't want to be
Got it.
someone else's liquidity.
Cool beans, man.
Yeah, and I mean it hits checks all the boxes, 3 to 1 or better, high or low, and even if it were to wick assess and stop us out, it's still valid if it closes above the lows. You know, that's the whole thing. It's like once you start getting this stuff down, and it's a time based thing. Like it's osmosis. Like the only way you learn is by doing, and the only way you get better is by like practicing. The same thing over and over again. Or I guess the better term is perfectly practicing, which is making sure that you have your checks in the box. Like I said, I used to have my checklist on on post-its around my on my computer, which is it has to do this, this, and this. These are the different confluences it has to hit for a trade entry. It has to have a 3 to 1 risk reward to my first profit target, and like bang, bang, bang. As soon as I hit my first profit target, I move to stop loss to break even, profit target 2, stop loss to in profit, somewhere between first profit target and entry. You know, basically just being almost like a monastic with it, like a monk. So, and that's all
What
I
about
did.
what about big movers?
Anything else? Any other comments?
What time are you going to be on the United States time? If I know you're in Norway,
Oh no, I'm actually in Sweden, but
Sweden. Oh
um,
shit, sorry, I keep mixing you
same.
and
Don't worry,
Egil shit.
same difference. It's the same
Same
difference.
thing. Yeah.
Yeah.
Is that like 2 p.m. here, U.S. time?
Yeah, so current time for me is like 5:38. So I guess Eastern time, I'm 6 hours ahead. It's probably 11:38 in the morning. No, yeah, 11:38 in the morning for you guys if you're on East Coast. Central is 10:38. The FOMC economic info just comes out in exactly 2 hours and 22 minutes. So I'm going to be streaming 15 minutes beforehand.
Yeah, for sure. Yeah, yeah.
Yeah,
That's what it, because his time is different. Got it.
yeah. Well, alrighty, everybody. Hope you guys got something good out of it. I'm gonna go relax for a bit and do a couple other work things, and then get back around to it. So,
Thank you, sir. Great session, man.
appreciate it, guys.
Take care.
Peace.